Meta actually surprised me, and they're making the right investments into their platform, and it's starting to make me feel very bullish on the company. And I got a name that's currently got a 26% equity yield, and it's a part of an ongoing spinoff, which I own in my portfolio. And so I'm going to cover both of those securities in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel, and let's dive right into this one. As you can see, Meta has had a lot of problems this year. The failure of the metaverse to launch in any sort of recognizable fashion. Now, I do believe that the metaverse will eventually launch, but it'll launch with the business community, with the AR function. It won't launch with the VR function, but that's just my opinion. And I think their partnership with other companies like Microsoft will go a long way, but investors are not as optimistic, and you can see it with the share price decline of almost 70% year to date. So if you've been a holder of Meta shares, it's been a tough decline for you. And one thing that I've been watching is that as Meta focuses more on their AI generation for your Facebook feeds, my concern was that they're gonna alienate people that currently use the app, because people use the app to connect with family and friends. They don't necessarily use the app in a TikTok-like fashion where a lot of what's being fed to you is other user created content. And this is an old article where Facebook actually tried to get around that and address that issue. And so they offered a friends and family feed. However, when I tested the friends and family feed, I noticed that they made it hard to find and navigate to this feed, which makes me think that the uptake wasn't as high. Instead, they probably noticed that people were being alienated off the legacy app as the Facebook AI recommendations were wonky. And so I think they're starting to realize this, and they're addressing it with more technology. And this is what I mean. This article recently came out on the Wall Street Journal, and they're saying that Facebook is publicly disclosing their actions here. And so what they said is that in the third quarter, their content report shows that only 1 in the top 20 posts that were trending on Facebook qualified as engagement bait. And so my concerns, which were made in the last video about Meta, are sort of, I guess, overdone a bit, because the problems with the AI recommendations seem to be addressed, or looking like they are addressing it. Meta looks to be making the right investments into content quality, and this is what I mean. As written in the article, earlier this year, virtually all of Facebook's top-ranked content was spammy, over-sexualized, or generally what the company classified as regrettable. Now that they're addressing this and using AI to identify what content is sort of like spammy and what's good content, they've made efforts to go after this. And why is this an issue? Because if you see this bottom paragraph that I've highlighted, amid plans to shift even more of its users' new feed towards Facebook's recommended video content, Meta actually feared that it risked alienating users and advertisers. Now, from my perspective, I only thought that they were going to potentially alienate users, but if you really think about it, what's the second order effect there? Of course, it's going to alienate advertisers as well, as they're going to get a less bang for the buck. So I didn't really think about that, but of course, the sentiment was correct. And what I was talking about, like, less people are using the app, and so you're just going to generate less advertiser revenues. And so the thinking was there. And so how are they addressing it? As part of their efforts in the new content quality war room, Meta actually sought to better identify what made users feel a post was trashy. And so what they ended up doing is they built a separate system, so new technology, to identify low quality content in Reels. And so I think this is very similar to how YouTube recommends higher quality content. And so Reels quality was not great when it launched, but now it's not bad. And they do believe that it reflects better detection of spammy content. And so essentially what I'm starting to see here is that they're making progress. And so I don't believe that the legacy apps are dead. And I'm going to keep using these apps. I use the legacy Facebook, and I also use Instagram. I've noticed that they're getting better, and I've noticed that they're keeping me on for longer. And so I don't think these things are dead. And I think what we're going to see as the new quarters come out and they report is that engagement continues to go up and up. The real risk now, and the one that AI can't really help them, at least right now, is with ad revs. I don't know if ad revs continue to go up in an environment where ad spending comes down. And so that's something that we have to think about and be prepared for. But if their usage is higher and engagements are higher overall, then of course the number of ads that are being shown to people increases. And so that might offset the decline in ad pricing at least. And so we'll see how this plays out. And I'm really interested in the story because if Meta shares continue to go down, there's going to be a certain price point where I think I might pull the trigger and purchase the securities. I'm just not there just yet. There's still a lot to learn here. And so let's see how it works. Now, the next name that I want to talk about that has an approximate 26% equity yield, which is also part of an active spinoff, is Vista Outdoor. Now, if you haven't been a part of our monthly calls as part of the Patreons, you have not probably have been aware of this name. We've been talking about it every month. And just to catch you up a little bit, Vista Outdoors is essentially two different companies. The first company is they sell ammunition. So they make and sell ammunition. So you can see the Remington brand there and the Bushnell brand. Those are very popular brands in the ammunition space. And then they also have an outdoor products company. And so that's where you get the Bushnell Golf GPS rangefinders. You got Camelback, you got Bell, you got Camp Chef. They also have Quiet Cat. And so essentially what they're trying to do is they're going to try and split these two companies apart. And you can see that that spin-off of outdoor products segment is on track. And so the way that this will work is you'll just get shares in the new company. And now, what is the thinking behind the spinoff? Well, when it comes to ESG requirements, there's a lot of people and a lot of mutual funds or institutional investors that will not invest in Vista Outdoor because they have the ammunition segment. Well, if you break apart the two companies, the ammunition segment will still probably have the low multiple, but the outdoor product segment is expected to have a higher multiple. So this spinoff, which you can get at a really cheap price right now, has the potential of just generating a return for you just from the spinoff alone and the outdoor products company trading on its own. Now, there's nothing guaranteed here. This is never investment advice. You guys got to look at this on your own. But my interpretation is that the outdoor products business will claim a higher multiple than what the ammunition business is claiming right now. So it looks to me like this can make money. Now, the other thing is, it's not like the outdoor products business is without risks, right? We're moving into a consumer constrained environment. And so where are they going to slow down spending? Well, it will be on outdoors products for sure. At least that's what I think. And so the outdoors product business can see a cyclical decline in this environment in their top line or revenue sales amounts. And now this is from the latest quarter on what the management said about the separations. And so the board of directors unanimously approved the preparations for the separation of their outdoor products and sporting products reportable segments into two independently publicly traded companies. 100% of the stock of outdoor product will be provided to, of course, the owners of the current shareholders. And so they expect the transaction will be completed in calendar year 2023. And they just reported their Q2 earnings of fiscal year 2023. And you can see that year to date, sales are slightly higher, 10% more than last year. However, notice that the adjusted EBITDA is 2% lower. And in the last quarter, adjusted EBITDA was much lower, 22%. So you might have a linear decline or a quarter over quarter decline, just worse comparables as time goes on with the consumer slowdown. So be careful. But what are they predicting for EPS at the end of the year? Well, they're saying that revenue is going to come in line with what it was last year. So that's not a bad move. And adjusted EPS is expected to be around $6 to $6.50. And so just at $6 per share, divided by the current share price, provides you with an approximate 22% equity yield. Now, I actually don't think that their adjusted EPS is going to be around $6 to $6.50. I think their adjusted EPS is going to be higher at $7. And that's how I'm modeling it out. Now, if you want to see the model that the Patreons get access to on this opportunity, you can get access to that model at the lower tier of our Patreons. So if you haven't done so, please check it out. And if you don't like it, I'll refund your first month subscription. Now, take a look at their 3-year outlook. They're saying that sales are expected to grow at approximately 10% for the next 3 years. Now, based on the trajectory of the economy and the rate at which interest rates are increasing, I just don't think that their sales are going to grow at that rate, at least not organically. And so they might have to revise this estimate unless they're looking to grow sales through acquisitions exclusively. I think without acquisitions, their sales grow at a much slower rate. And what slow rate am I predicting? Well, you can see here, this is the model that the Patreons get access to. I'm nowhere near that 10% annual growth rate. Instead, I think it's a great amount of upside if it's not done organically, but I don't think it's done organically. And so they're going to have to use acquisitions to get to this goal. And that can be a risk. And why do I believe that using acquisitions can be a risk in this environment? Well, here's a recent transaction, which was the Fox brand. In this strategy, they purchased the company for $590 million, which was financed through debt. And it looks like the purchase multiple of their expected earnings, which I just put together myself, seems a bit high in this environment. They look to pay 21.3 times earnings for this transaction. So you can see with my note on the right that an acquisition strategy has its own risks. And it primarily comes down to if they're overpaying or not, and is the financing done for the transaction dilutive, or does it add risk with excessive debt? In this case, it was a 100% debt transaction, and it was purchased, in my opinion, at a multiple that may have been high in this environment. And so this is where investors need to be aware of the potential risks of this company's strategy. And as you can see, I'm not giving them a high terminal multiple. I'm just using 12.5 times earnings. Now, this takes into account both companies. And so I'm valuing the company at approximately $51 per share, but I'm penalizing them approximately $21 per share for that excess amount of debt that they have on their balance sheet. And so the current valuation is $62 per share, but that's much higher than the current share price of $26.89 per share. And so the current EPS run rate reflects an earnings yield of approximately 26%. Now, why is that different than the 22%? Because I actually think that they're going to probably earn $7 per share this year. Now, I might be wrong. You guys decide if this is a viable opportunity for you. I think a lot of the Patreons decided that this is not for them, and that's totally cool. I still own it. We'll see how this plays out. Now, if you want to see my latest video on Meta, where I did a complete breakdown of the latest quarter, it's a long video. It's like 40 minutes, but it's the most detailed video that I have seen on YouTube. Well, you can get to that video right here.